Welcome back to NM Arena. This video is an overview of the Indian financial system. The economic growth and development of any country depends on the efficiency of a developed financial system. The changes in Indian financial system can be studied by categorizing it into three stages. The first stage is before independence, the second stage is after independence but till 1990, and the third stage is after 1990. First of all, let us see what was the situation in Indian financial system before independence. The financial system was unorganized then, and the capital stock exchanges had very few industrial securities being traded in the securities market, and there was no separate issuing institution. Also, the participation of financial intermediaries had almost been nil in long-term financing of industries, and the industry's access to outside savings was also restricted. Due to this, the financial system was not capable of achieving high rate of industrial growth, especially in the growth of new and innovating enterprises. A number of developments took place in the Indian financial system after independence. Let us see what are those changes. During the second phase, the main thrust was to transfer the ownership from private to the public sector as well as setting up of new institutions in the public sector. The beginning of the transfer of ownership from private to government control took place when the Reserve Bank of India was nationalized through the Reserve Bank Transfer of Public Ownership Act 1948. The entire share capital was acquired by the central government. The first five-year plan, launched in 1951, aimed at the development of the rural areas in the country, and the All India Rural Credit Survey Committee in 1951, established by the RBI, they criticized the working of the Imperial Bank in its report submitted in 1954. It suggested the setting up of a state bank by taking over the Imperial Bank of India and other state associate banks. Accordingly, the State Bank of India was constituted on July 1st, 1955 by taking over the control of the Imperial Bank of India under the State Bank of India Act 1935. Another important change that took place in the Indian financial system was the nationalization of 245 life insurance companies in 1956. As a result of this, the Life Insurance Corporation of India came into existence in 1956 as a statutory institution incorporated under the LIC Act 1956. Another important step in this period was taken in 1969 when 14 commercial banks with a deposit base of 50 crore rupees or more were nationalized. And again in 1980, six more private sector banks were nationalized, bringing up the total number of banks nationalized to 20. And then there was the nationalization of the general insurance business. It was done by setting up of the General Insurance Corporation in 1972 by passing the General Insurance Business Nationalization Act in 1972. 107 insurers, including branches of foreign companies operating in India, were amalgamated and grouped into four public sector companies, namely the National Insurance Company Limited, the New India Assurance Company Limited, the Oriental Insurance Company Limited, and the United India Assurance Company Limited with its offices at Calcutta, Bombay, Madras, and Delhi. Then there was setting up of financial institutions. That is, the government control over the sources of credit and finance led to the establishment of many financial institutions in the public sector. And the main objective was to provide medium and long-term industrial finance to the corporate sector. A number of Development finance institutions were set up in India, beginning with the Industrial Finance Corporation of India that was established in 1948 as the first development bank. Later on, many other development institutions were also set up, just like the State Financial Corporation or the SFC, and the Industrial Credit and Investment Corporation of India Limited or the ICICI, and the Refinance Corporation of India, the RCI. Then in 1964, the IDBI or the Industrial Development Bank of India, and then came the State Industrial Development Corporation or SIDC, and the small industries or the State Small Industries Development Corporation SSIDC. All these institutions came into existence after that. In addition to that, a number of other institutions also participated in industrial financing by mobilizing public savings through the introduction of insurance schemes, mutual funds, units, etc. And these institutions, also called as investing institutions, included Unit Trust of India, established in 1964, LIC, that was established in 1956, and the General Insurance Corporation. Some more units were set up to provide help in specific areas such as the rehabilitation of the sick units, export finance, agriculture and rural development. The Industrial Reconstruction Corporation of India, or the RCI, was set up in 1971 for the rehabilitation of the sick units. In 1982, the Export Import Bank of India was established to provide financial assistance to the exporters and importers. In order to meet the credit needs of agriculture and the rural sector, the NABARD, or the National Bank for Agriculture and Rural Development, was set up in 1982, and it is responsible for the short term, medium term, and long term financing of agriculture and the allied activities. And initially, the commercial banks performed the role of accepting deposits and financing the short term needs of trade and commerce. But RBI, through changes in credit control measures, diverted the bank credit to industrial sectors in 1951. Gradually, the commercial banks entered into the field of underwriting of issues of capital and term lending. And the Refinance Corporate of Industry was also set up as a subsidiary of RBI for providing refinancing of term loans by the commercial banks. Another development in the financing was the entry of major banks in merchant banking, new issue management, corporate counseling, capital restructuring, and portfolio management, etc. A number of subsidiaries were set up by the major banks such as Can Bank Financial Services Limited, PNB Capital Services Limited, SBI Capital Markets Limited, etc. to carry out the long-term financing of the industrial sector. And the savings mobilized through mutual funds were also invested in industries. The Indian financial system has undergone massive changes after the announcement of the new economic policy in 1991. The LPG has transformed Indian economy from closed to an open economy, and the corporate industrial structure has also undergone changes due to the delicensing of industries, financial sector reforms, or reforms in the banking or capital market, disinvestment in public sector undertakings, reforms in taxation and company law, etc. And the government role in the distribution of finance and credit has declined over the years. One of the important changes was the permission given by the government for the private sector to enter into banking and insurance sector. The development financial institutions performed the role of term lending institutions, extending loans for the project finance, underwriting, subscription, then lease financing, etc. They received funds from the government and the RBI. And after 1990, remarkable shift was seen in the activities of these institutions. They engaged in non-fund based financial activities like merchant banking, project counseling, portfolio management services. mergers and acquisitions, new issue management, etc. And the DFIs raised funds through issue of bonds carrying a floating rate of interest. And the DFIs earlier sponsored the infrastructural institutions like the technical consultancy organizations, management development institutes, etc. This focus shifted to the development of capital market. As a result of this, some institutions were promoted by the development finance institutions like the CRISIL, WICRA, CARE, which are the credit rating agencies. In addition to that, so the over-the-counter stock exchange of India, National Stock Exchange, Stock Holding Corporation of India, IFCI, financial services, etc., were also set up. In the unorganized non-banking sector, a number of non-banking financial companies have emerged, providing financial services partly fee-based and partly fund-based. Then activities included equipment leasing, hire purchase financing, bill discounting, then venture capital, housing finance, etc. And the fee-based services like portfolio management, issue management, loan syndication, etc. was also included here. Initially, the Unit Trust of India was a single organization issuing the mutual fund units, but the mutual funds are sponsored not only by UTI now but also by banks, insurance organizations, FIIs, private sector, etc. There are offshore funds being sponsored by foreign institutional investors or the FIIs and the Indian financial institutions. The mutual funds are gaining popularity among the small investors also. In addition to that, the Securities and Exchange Board of India was established under the SEBI Act 1992 for protecting the interest of investors in securities and to promote the development of the securities market. The capital market has undergone tremendous changes over the years with the issuance of regulations by the SEBI in respect of the brokers and dealers in the trading and settlement, and more transparency was brought in trading and settlement practices. And setting up of the National Stock Exchange and the Over-the-Counter Exchange of India were all the developments in the stock market, and private firms were allowed into the insurance business. And the introduction of derivative trading was another development in the Indian financial system after 1990. In addition to all these developments, some other developments have also been seen in the Indian financial system. The use of the internet services in the banking system, like the mobile banking, internet banking, etc., have been seen recently in the Indian financial system for the development of the banking system itself. And the merger of the SBI and its subsidiaries into a single State Bank of India. And many other banks have also merged. And some other banks are in the pipeline for the merger. And a number of other developments have also been visible in the money market, capital market, and the banking system of our country. It is continuing. The development is still ongoing and proceeding. With this, we can end this lecture. Thank you for watching this video. For more videos, subscribe the channel.